Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Dr. Amir Baluch. He is a wealth strategist and private fund manager with over a decade of experience in private equity and securities. He has co-managed or funded over 80 projects, totaling over $700 million, and he helps professionals achieve financial independence through strategic passive investments. Amir, thank you so much for coming on today.
Hey, thanks for having me on.
So you have an interesting background prior to getting in real estate and securities. You were in medicine. Can you tell us about your personal and professional background prior to getting involved with what you're doing now in Baluch Capital?
Yeah, so before getting involved here, I was an anesthesiologist, and a lot of times we're done at 2 or 3 p.m. and I can't sit still. So within 1 year of finishing residency, and this was back in 2010, I ended up getting my real estate license, my Series 6322, and joining a boutique investment bank because I'm a lifelong learner. And when I want to get good at something, I like to learn from the best. So it's almost like a second residency, but in investment banking and real estate securities.
Why did you choose going into that as kind of, I don't know if I would call it a side hustle, but a hobby or a side hustle, whatever you might say, at that point in your free time?
Well, I was kind of interested in this back in the year 2000. I kind of had some tragedies happen to me. Well, the first thing is I didn't get into medical school, and I thought I was a shoo-in. I had the grades. I had a pretty good resume, and I didn't get in. So I was kind of shocked at the time. I started not to trust any path to be guaranteed for me. So I put my life savings into my first business venture and lost that in about a year. I was doing door-to-door sales and electronic payments. And so then I took the safe route. I went to move back in with my family in Midland, Texas. And unfortunately, 2 months later, my parents went bankrupt, and I didn't think that could happen since my dad was an internal medicine doctor and I think making a lot of money. So because I thought that's what all the doctors do, but maybe that didn't happen. So because of some lack of planning and understanding of personal finance, that's when I got interested into it, but that's mainly out of necessity. So I was like, somebody better get a hold of this. And so I started reading a bunch of books. I was going to webinars or not webinars back then. It was mainly live conferences. So you hear an ad on the radio and you go to a live conference, right? I know today, 2025, half a quarter of a century later, it's a little bit different, but that's kind of how I got involved. I didn't want that to happen again. And then between the year 2000 and 2010, those 10 years, I was really learning a lot. And I did start up some other successful e-commerce businesses. I did get into real estate through one of my friends at a private REIT. And so I was gathering my mentors and everything like that while I was going to school. And as soon as I finished, then I went, to the next level, which is getting my securities license.
Oh, that's fantastic. So when you were getting started and you're going from your, through your entrepreneurial journey from medicine to finance, what were some of the what were some things that you took away from your kind of your career, your studying in medicine that you brought into your entrepreneurial life?
Well, what's interesting about anesthesia is you're really not allowed to make a mistake. So there's a lot of double checking and triple checking, and we have systems and processes to make sure we're ready for anything. So, we have somebody's life in our hands, right? So we're also not afraid to ask for help, believe it or not. If there's, patient is coding, the first thing I do is say, okay, call for help while I get this under control. We don't know where this is going to go, right? So we leave our egos at the door when it comes to taking care of high acuity situations. And so that's kind of transferred into the entrepreneur world where, if I want to decrease the risk, if somebody is becoming a capital partner with Baluch Capital, how do I decrease the risk for them? Because now it's kind of like they part of their life in my hands. I'm going to ask for help if I don't know what's going on. I'm going to overlearn. I'm going to go the extra mile and work for a broker dealer / investment bank. I'm going to get my licenses. I'm going to double check and triple check everything. I want to think what's worst case scenario. Like if you're going to have surgery, pretty healthy guy, come in, chop off a toenail or whatever the surgery is, probably nothing bad's going to happen. But we never know. So we always have our emergency plans ready to go. And so I carried that over to the entrepreneurial world, and it's paid off pretty well because we've dodged some bullets and recovered from some deals that maybe, market wasn't in our favor or something changed. So that's actually helped a lot.
That's awesome. That's great that you're able to utilize that into a different field. So let's talk a little bit about what you have at your firm. You're a little different from other people that we have on the show. I know we were talking about this beforehand as being a licensed securities broker. And your firm focuses on several different asset classes, which is probably one of the beauties of this, that you're able to access this. Whereas I think people that are just general partners or, operators in a deal, they focus on one, maybe two asset classes because that's what they can focus on because they can't just bring capital to every other deal. Can you tell us a little bit about the asset classes, kind of what your firm does and the different investment offerings that you have?
Yeah. So the whole reason for this, by the way, is, somebody comes to me, I want to be able to give them the best advice. And there's no one single shot answer for everybody. Everybody has a different situation. And because of Markowitz's portfolio theory, people not familiar with that, the one sentence summary is if you spread out your investment money, your portfolio into 8 different asset classes that are not correlated, which means different variables make them go up and down, you could reduce your portfolio risk by 80% while still getting the same return or maybe higher. So basically the risk reward in your portfolio is you're definitely skewed in your favor if you do that. So I wanted to recreate that under one platform. And we do it mainly with alternative investments, which are separate from traditional. So now what asset classes do we cover? So you got the traditional ones over here, stocks, bonds, mutual funds, all that stuff. You can go online, click a button, and it's done. And then you have the world of more private investments or alternative investments, which fall under 3 categories. There's going to be real estate. Then you have private equity, which just means private businesses. And then you have private credit, which is kind of like debt. Like the banks, that's how they invest into things. They just want to get their interest rate, right? So those are the 3 categories that we work in also, and we've kind of duplicated it where, in real estate, we did some commercial real estate, especially when I was with the broker dealer. We focus more now on single family homes and built to rent. And then every now and then we'll do a commercial deal if it looks like a home run deal. In private equity, I mainly focus on life sciences because I can do due diligence on that easier than other industries. And also e-commerce, since I've been doing e-commerce for about 25 years. And I just stay there. I just stay in my lane when it comes to private equity and those 2 things for the most part. And then in private credit, we've actually created some fixed income products. Like we did have a corporate bond fund. We do promissory notes against real estate. So if people are looking for fixed income and investing as debt, then we have that as well. That's pretty much a quick summary of what we do here.
Yeah, there's a couple unique offerings I saw on your site when I was doing preparation for this, and one of them was an e-com one, and there was a couple other ones. Can you go into those kind of how those are structured? Because these are very unique. I mean, obviously you have you're very experienced and seasoned in this, which gives you a leg up in investing in it. But I think many other people might not understand how profitable they can be.
Got it. So, we saw with the e-commerce one, we kind of fell into that on accident. So we saw that there was a need for alternative funding for e-commerce sellers, especially on Amazon, which has 60% of the online e-commerce transactions. And so some people that are good sellers can only go so far. They have to borrow money, and the banks will lend off of your revenue. But since we had experience in the space, we could lend on the asset. So if they were buying, let's say, a box of Legos or a Barbie doll, we actually knew enough about those products to say, hey, if we buy these for them or lend them money to buy those products, we know they're coming in at maybe 50 cents on the dollar. And we actually were able to charge a lot, 2, 3, 4% a month. And we're giving half of that to investors as a pref. So that was our e-commerce debt fund, which closed very quickly because it grew very quickly. And then we only had so much capacity. But that was a pretty cool one. And it's almost like, imagine if you're doing hard money lending, you're lending on real estate, you have that hard asset there. if you're in a hard money fund, maybe the return could be anywhere from 7 to 12%, depending on, leverage and things like that and your position of the capital stack. But I took that kind of hard money lending concept that was one of our funds when I was working at this boutique investment bank, and I applied it to e-commerce.
Oh, that's very cool. That's very unique.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
With real estate coming in, where we are now, it's 2025. We have a new president. What kind of real estate opportunities and trends are you seeing? And how is your firm really positioning themselves to take advantage of them?
Well, we started switching gears even in 2018 and 2019. We started moving a little bit away from commercial, and we started selling our commercial real estate assets because interest rates were so low. And if interest rates are low, buyers are able and willing to pay a higher price for that existing cash flow. So it makes sense to sell high, right, and buy low. So we sold high and we moved into single family. We were already in single family developments, but we basically doubled and tripled down into that because the valuation isn't as set. The valuations of single family is not as reliant upon interest rate changes. So, because the valuation is more based off of comps, like what did your neighbor sell for? Oh, it sold for, $400,000. Okay, my house is probably about $400,000. And it adjusts for inflation too, because all the prices to build the home adjust for inflation and things like that. So we moved to there pretty heavily in 2018, 2019, 2020. We were completely out of commercial real estate, and we just focus on single family build to rent communities, which it's almost, imagine if you had multifamily, but it was flat and single detached homes with lots of amenities and a backyard, 2-car garage. Like that's basically what we have done in the single family as an alternative to multifamily. So on the real estate side, those are the things that we've been focused on.
Tell us about that opportunity in build to rent. How is that? Obviously, the one thing I think is one of the best things about that kind of model is I think you're going to get people stay there for many, many years. You're going to get a stickiness of the tenant. But can you tell us kind of some of the benefits you saw of why that's a great investment class?
Well, one of the things you mentioned has a double bonus. So when people get that stickiness and they stick around, one of the biggest expenses in multifamily, for example, is the turnover. So, you're out money because it's vacant, and then you have to re-prep the whole unit for the next person. That's like the biggest expense in multifamily, actually. We don't have that, and we're still getting rents. And also, there's not that much of a ceiling on how much the rent can go up. So if you're renting out a 2,400 square foot or a 3,400 square foot single family home, these people, the value of that is really high. You can't get that in an apartment. And there's not that many single family homes that are rental ready and very clean. In fact, it's only 5% of the rental market is this build to rent communities where you actually do have a community. Maybe you have a pickleball court, you can share a gym and a club room. And some of these places even have, small libraries and things like that. So the benefit is you attract a better quality tenant that's willing to pay a higher rent and stay there a lot longer. And they actually feel like it's their house, so they take better care of it. The same thing's actually in short-term rentals. You would think people come in and trash the place because they're there for a day or two. But if you have an overall nicer product, people feel that they're like, man, I really need to take care of this. Same with single family. So even if somebody does leave, you're not going to spend that much money getting it re-prepped for the next person. So those are a couple benefits there. Another thing too, just supply and demand is going to take us at least 15 years for the supply to catch up with the demand for single family rentals. And it's only going to keep going up because right now, I saw in a report yesterday, the average income you need to have to buy the average home in Dallas is about $127,000 income. There are a lot of Americans that don't have that, but they still need a place to live, and they don't want to do an apartment. They want a backyard for their dog to run around or their kids to play in a little bit. You really just don't get with an apartment. And that segment of the population is growing and wanting an alternative, and it's going to take forever for us to meet the demand. So, the supply-demand ratio is well in our favor for the next 15 years. So that's probably going to be our home base. Those are most of the benefits of the build-to-rent communities.
No, I appreciate you bringing that down, because I think you see these headlines and they say, well, we need this many units and we need this. And then when you read into like what's actually going to be built for that millions of units that are required, it's like this Class A apartments in like city centers and stuff. And that's great in certain markets. And that's great for a target demographic of people that might be young professionals, right? But at some point, they're going to usually want a little bit more space, possibly. They want to and that's what I see is like, not every new unit is the same, right? Is created equal. And I think the build to rent is a huge benefit because people actually are living in a house. They just don't have ownership at that point until they're able to afford it.
Right. There's definitely a need that's not being met by a lot of developers right now. So it's definitely a good place to be. And affordability in general too. Like if somebody is going to spend a lot, I mean, there's one bedroom apartment just the other side of this window. I mean, it's like $2,400 for a one bedroom, right? I mean, it's kind of wild. So imagine what a 2-bedroom is, and you really can't have a family for a $3,200 a month 2-bedroom apartment, right? Those close to downtown and the buildings and all that. So, getting those people to get into these single family homes is definitely a good move.
As you kind of move forward here, I had a question, because we talked about you being licensed, and I don't know if people understand the extra hoops other than being licensed when you're bringing out a deal, and kind of the process, just like a short overview of kind of how that works in working with the broker you're working with to oversee, and what kind of checks have to be done before that can be really offered out to your investors.
Yeah. So, a couple things have to happen. The structure has to be proper. So sometimes there's a LP-GP structure, limited partner, general partner structure, where the limited partner does nothing but write the check. And that basically is the definition of securities. When 2 or more people passively invest into a project that's run by a manager, that's a security. And the limited partners have no say in what's going on. The next level could be a joint venture where you do have some say, but not a lot. That's technically not a security. It's kind of like a partnership thing. And so some people put together deals like that. In fact, my last deal we closed on last week was joint venture with about five accredited investors. And then you have the co-GP structure, where if somebody is actively involved and has significant material participation in the management of the project, then they could be a co-GP. But most investors are not that. And even the ones that are probably shouldn't be. So it's mainly the LP-GP structure. So when you do that, now what type of regulations are you in? Most securities will be regulation D, 506 B or C. So the B means you can't advertise. So like I might just text you and say, hey, we got a deal coming. This is what it is. If you want to jump on a call, let me know. And then the C is kind of like for crowdfunding. Now you could market online, but there's more strict rules. Like you have to verify that you're accredited. You can't just have them say, hey, I'm accredited. You actually have to get some third-party documents or a CPA letter. For the most part, that's the world that we live in when it comes to securities. And there's a certain amount of language that needs to go into it. There's a certain amount of things that you can't say. So, for example, you can never say, oh, man, this is a sure thing. because that could be construed as a guarantee, and there's no guarantees except for life insurance products. So you could actually use the word guarantee in those. Other than that, there's pretty much no guarantee. And then in some securities, like when I was with the broker dealer, you're not actually allowed to give projections, believe it or not. So if you're coming through the broker dealer side, you can give data of the project and say, hey, the rents are here. We think we could take it here. And here's some past examples. And let me know if you want in on this one. But you can't say, hey, I think we're projected about 20% return a year. You actually can't say it. So now, if you're not with a broker dealer and you're falling under an exemption, like I am, I'm technically right now, I'm an exempt reporting advisor, also called a private fund manager. There's a couple different words that mean the same thing. So under the exemption, I can actually give some projections. And so it gets a little bit nuanced with the marketing, and you have to make sure you do it right. Most people don't do it right unless they spend a lot of money on attorneys. And so that's the main thing is, how are things being presented and what are you doing, and do you have the proper structure? Because the penalties for these things are pretty bad if you mess it up. So in fact, when I was with the broker dealer, I didn't even email anybody unless I got that email approved by the managing broker dealer. And most time I just call people on the phone. I don't want to accidentally text something that could be construed as being something wrong. So I was on the phone a lot and going to a bunch of coffee meets. That's what I did. So, but there's so much regulation there. I mean, I actually liked it. You know, it was so strict, and the underwriting is so strict, and you had to cherry pick the deals. So I was looking at like some of the best deals in the Metroplex and how the best operators operate it and the reporting that has to be done. It's just so awesome to, you know, I had to step up to a really high standard to even, you know, hang with these guys. And so it was really cool to start off, you know, my career a little bit like that before going off on my own a few years later.
Interesting. Thank you so much for breaking that down for some people that might not understand the nuances behind licenses and everything like that. Yourself being a physician and, you know, your past financial issues with your family. I mean, what are some challenges professionals, specifically physicians, have regarding their finances and financial literacy that you usually see when you speak to them?
You know, one thing is they're really busy. They don't have a lot of time. I mean, sometimes, you know, if they're done with clinic at 5 or 6, they got maybe 2-3 hours with their family. They don't want to spend 2-3 hours just digging through numbers and going to another meeting. So it's like, so they're pressed for time. They want to process information quickly and make a decision. And sometimes that's not the best way to do things. Another thing is, if you're too busy to look at deals, you're definitely too busy to plan. And it's a simple thing to plan, but nobody teaches you how to plan ahead of time and say, hey, let's do a 10-year goal. Let's do a 20-year goal. And then it can be a little bit simple. You could actually do it on an Excel file, like how much do you need to save? What if your first goal is, hey, let me get $5,000 a month passive income? Well, you have to do the math. That's $60,000 a year. If you're going to get 10% a year, you need to have $600,000, right? So how long will it take to get $600,000? If you're saving $100,000 a year, it's going to take you 6 years, right? So and then what does that leave left? And now how much you have left for the mortgage and the kids' tuition? You got to actually break it down. But most people are just winging it. And, you know, actually some doctors, they could wing it because they're making a lot of money. Or they own surgery centers and stuff like that. And they could probably wing it and still be okay. But most people can't wing it. And when taxes come crashing down and you got private school and a couple life surprises, and then maybe throw a divorce or two in there, it doesn't look really good if you don't plan. In fact, I'm going to do an Instagram reel on this. It's going to be amazing. I'm just letting you know. But there's a chart where, you know, if you track a UPS driver and he actually planned, so let's say, you know, you're 21 years old, you're going to go to medical school, you're going to be a UPS driver. The UPS driver, he's making money and he saves 10% of his money, and a doctor just goes into debt but then starts making money, and he does the same thing, puts 10% in investments. It takes about, the physician will be somewhere in his early 40s before they match the net worth of a UPS driver. And if the UPS driver put in the hours that a doctor does, the 80 hours a week, that doctor is not going to catch up with the UPS driver till he's like 53 years old. So imagine, that's how that shows two things. One, the importance of planning, and two, even if the physician plans similarly and is investing 10% of his gross income, he still won't get to where a UPS driver level until he's 53. And if you want to retire at 65 or something, you got like a 12-year buffer, right? So it's kind of so really you got to plan for that 10, 12, 15 years of training where you're just negative the whole time. You got to overcome that by probably investing more than 10%, maybe 20, 30, 40% of your gross income, depending on how much you're making to figure out whatever your magic number is. And I surveyed some physicians. A lot of people say 5 million. Some people say 10 million is their number. And even that doesn't count inflation, right? So by the time you get 10 million, that 10 million is worth 5 million, and that 5 million is worth 2. So that you really got to plan for the inflation, the emergencies, and all that stuff, and just put on a Google sheet or something. And I have some templates too, so we want to look at it. I'm happy to send it over. So
I know it's a lot of great thing, being proactive about your finances and actually doing planning, not just kind of praying and spraying kind of a thing, you know what I mean? Or spraying and praying type of investing strategy, which doesn't always work out. As we talk about physicians, I mean, as you're being an entrepreneur and an investor, what are some common mistakes you see entrepreneurs and investors make in regards to everything from running businesses to investing in real estate or other asset classes?
The biggest mistake I see is maybe people are a little bit too optimistic and they focus too much on the returns. So it's kind of easy to understand, okay, what will the returns be? You buy a piece of property. Okay, let's increase the rent. And then this number happens and I make this much money. It's more important to actually find out how you lose money. Hey, if lumber goes up, are we okay? Hey, if the rents don't go up 3 or 5% a year, are we okay? If an apartment complex opens across the street, are we okay? If a competitor comes in, if you're in a gym or a med spa, whatever investment you're investing in, when the competition comes in, what's going to happen to you if you got to split the market in your zip code 50-50 with somebody else? So, and then when that happens, what's your plan B? So I think if you are going to be a limited partner, I'm guessing most of the people listening are limited partners or passive investors. The best thing you could do is understand risk. If you take care of the risk and mitigate the risk, you don't really have to worry about the upside. There's a higher chance that there will be an upside for you. And as long as there's an upside, however big or small it is, you can always play the ball again when you get your money back and rotate it in there. If you take, 1 or 2 losses on a big deal, it takes a very long time to recover from that. That could set you back a whole decade from your goal with just, 1 or 2 big losses.
One thing I started doing from a mentor of mine explaining it to me years back was that look at past investments, whether you're active or passive, and even the ones that you made money on. If you look back on them and you review them and you're like, was this actually a good investment? And you'll be very surprised at what you come back and see. And you're like, this was a really good investment. This was a better investment, but I didn't make as much. Or this one I just got lucky with, or whatever it is. And if you look back on it, and it's like, it's tough saying, right? You know what I mean? That you're, everybody wants to say that they're a fantastic investor. But if you look back on it, you're like, oh, that was a little riskier than I should have been, getting involved with. And these are the ways to mitigate in the future. Not just looking back and learning lessons from the ones where you lost money. It's also the ones that you made money on. And maybe that's a little too, it's a little too risky for what you're trying to do, because, they are alternative investments. You have to really know what you're doing when you're underwriting them. And there's not going to be a ton of regulation behind them. So, or any really. So it's something that people really have to understand who they're investing with, understand the investment, and really, like you said, understand the risk. It's definitely great advice.
Right. Makes sense.
So how can our listeners learn more about you, Amir, and what you got going on with your firm?
Well, you can check out a little bit about us on our website, baluchcapital.com. I've started posting a lot more educational stuff on my Instagram, amirbaluch.md, and it's a little bit more entertaining. We got some video effects guys on there doing some cool things, and it's only about 60 seconds long, so everybody's got 60 seconds in the day, right? So that's pretty cool. Also, somewhere I think we'll put in the show notes if somebody wants to book like a clarity call with me. I'll offer that like just a quick 10 minutes. If somebody's like, man, this is my situation. What are the next 2 or 3 things I should do? I'll point them in the right direction. Because it is kind of confusing out there, and sometimes people don't have anybody to talk to, and I could share my resources or say, hey, look at this group, read this book or whatever. And then if somebody wants a free copy of my latest book, Prosperity Prescription, it does kind of go through a bunch of different asset classes, and it has some embedded videos with QR codes that pop up at you and explain more detail about due diligence. So if you're interested in that, we get you a free copy of that book, just cover the shipping, and you could learn a little bit there, and also a little bit about what we do that's in the book as well.
Thank you. Well, that's great. We'll put all those show notes, all those links into the show notes. And thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Sounds good. Thanks for talking.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.